Have you ever tried to solve like a jigsaw puzzle where the pieces actually change their shape while you're holding them?
Oh, man. That sounds incredibly frustrating.
Right. But you think you have the corner piece, like the solid, undeniable fact about the economy, and then by the time you try to place it on the board, it's warped into something completely different.
I mean, it's a great way to describe the current economic landscape, honestly.
Mhm.
We are so used to looking at the global market like an engine. If a belt snaps, you just point to the broken belt, replace it, and move on.
Exactly. But right now, we aren't dealing with a simple broken belt. We are looking at this massive geopolitical polycrisis where the traditional boundaries between industries, nations, asset classes, they've completely dissolved.
Yeah, they really have.
So it is Tuesday, March 31st, 2026. And today we are taking you on a deep dive into a really fascinating stack of sources. We've got comprehensive Wall Street financial analyses, live combat reporting from CBS News, and corporate merger documents straight from Cleary Gottlieb.
And the mission here is really just to synthesize all of this for you. I mean, to protect your investments, or honestly, just to comprehend the nightly news right now, you have to look past the flashing red headlines.
Right.
We need to examine the structural, the tectonic shifts happening right beneath the surface of this crisis.
So let's start with the physical reality that is currently rewriting the rules for literally everything else. The global economy has a maritime jugular vein, basically. And right now, it is being squeezed completely shut.
Yeah.
We're 5 weeks into this major conflict involving the U.S., Israel, and Iran, and the Strait of Hormuz is effectively closed to commercial traffic.
And to understand the magnitude of that closure, you really just have to look at the math. I mean, that single narrow stretch of water handles roughly 20% of the entire world's daily oil supply.
20%.
Yeah, along with a massive volume of liquefied natural gas. So it is a total blockade of the market's baseline energy source.
Which is the direct physical reason you're seeing gas prices in the U.S. soaring past $4 a gallon for the first time in almost 4 years.
Exactly.
But before we dig into how Wall Street is reacting to that, let's just establish the facts on the ground. And actually, just to level set with you as we dive into this, we are looking purely at the direct reporting from our CBS News and Wall Street sources today.
Right. It's really important to emphasize that.
Yeah, we are breaking down the physical events and their economic fallout impartially. We are not taking any political stance on the actions or the policies of the Trump administration, Israel, or Iran. The goal here is literally just to map the reality of the situation so you can understand the economic shockwaves.
Well said. And that tactical reality is shifting by the hour, honestly. Like overnight, a U.S. strike hit a facility in the central Iranian city of Isfahan.
And what's the significance of that specific site?
Well, intelligence reports suggest this site holds highly enriched uranium. But equally critical to the economic picture, there was another strike that took a major water desalination plant on Gresham Island completely offline.
Wow. Taking out a desalination plant in that region, I mean, that isn't just a military maneuver. That is a structural blow to baseline survival infrastructure.
Absolutely.
Meanwhile, an Iranian drone struck a Kuwaiti oil tanker, the Al Salmi, right at Dubai port. State media confirmed it was fully laden with crude oil. And this is really where the conflict jumps from physical geography into the corporate sphere.
Right, the cyber and corporate targets.
Yeah, Iran's Islamic Revolutionary Guard Corps just openly declared 18 U.S. tech and finance companies as, quote, legitimate targets. We're talking about Microsoft, NVIDIA, Meta, Tesla, JP Morgan.
And the justification Iran is using is that the AI and advanced communications technology from these companies are actively being used by the U.S. and Israel to track targets.
Oh.
Yeah, it completely shatters this illusion that Silicon Valley is somehow insulated from Middle Eastern geopolitics.
Yeah.
If your servers process the data used in a conflict, you essentially become part of the battlefield.
And navigating this battlefield politically has been incredibly complex. We're seeing this deeply contradictory, like dual-track strategy out of the White House right now.
Very contradictory, yeah.
President Trump is publicly calling the Isfahan strike a beauty and telling allies like the UK to essentially go get your own oil.
Right.
He's signaling that the U.S., which produces a lot of its own energy, obviously, won't bear the full burden of opening the strait for countries that rely on it more.
Yet, simultaneously, the Wall Street Journal is reporting that the president is actually telling his aides he's willing to end the military campaign without even forcing the Strait of Hormuz to reopen.
Which is causing an absolute fracture among global allies. I mean, U.S. Gulf allies are privately pushing Washington to continue the pressure to permanently cripple Tehran's leadership.
Yeah.
But then European nations like France and Italy are pulling back. They're restricting U.S. military access to their airspace and bases. The coalition is splintering.
Because every nation is suddenly prioritizing its own immediate energy security over the broader alliance. They kind of have to.
Okay, so if you're listening to this, here is the giant, glaring contradiction we need to solve together.
Let's hear it.
If the physical reality is that the oil is blocked, tankers are actively burning at Dubai port, the tech sector is under threat, and international alliances are fracturing, why did the U.S. stock market just experience a massive relief rally?
Yeah, it's wild.
Advancers beat decliners 5-1 on the New York Stock Exchange today. The S&P 500 jumped over 1.6%. Are traders just completely ignoring a war?
It looked like pure delusion on the surface, doesn't it?
Totally.
But this really highlights a dangerous divergence between the tactical reality of a war and the mechanical plumbing of the stock market. Because the market didn't rally because the oil started flowing again. It rallied based on a technical mechanism called short covering. And that was triggered by that Wall Street Journal report about a potential diplomatic off-ramp.
Wait, let me see if I have the mechanics of this right. A short seller borrows a stock and sells it, right? Hoping the price goes down so they can buy it back cheaper later and pocket the difference.
Exactly.
But if a headline drops hinting at peace, they panic. They rush to buy the stock back before the price goes up and wipes them out.
You nailed it. And when millions of short sellers all rush to buy back stock at the exact same moment to cover their positions,
It drives the price up for everyone.
right, it creates this artificial wave of buying pressure. It is just a mechanical, technical bounce. It has absolutely nothing to do with the fundamental health of the global economy, and it completely masks the underlying structural damage being done by the blocked oil.
So it's basically a mirage. If we want to see the real structural damage, we really have to look at the energy markets. Brent crude surged roughly 60% in March alone. West Texas Intermediate, or WTI crude, is settling above $100 a barrel for the first time since 2022.
Yeah, it's massive.
The S&P 500 energy sector gained 11% this month. It's the only sector poised to end March in positive territory.
See, in a geopolitical crisis of this scale, high oil prices act as a massive, unavoidable tax on the broader global economy.
Because everything needs oil.
Literally, every single thing that is manufactured, shipped, or consumed requires energy. So the energy producers are the only entities effectively insulated from the chaos because they are selling the very thing everyone is desperate to get.
But that energy tax puts the Federal Reserve in an impossible trap, right? I mean, the Fed just announced they are holding interest rates steady at 3.50 to 3.75%.
Yeah.
And they revised their 2026 core PCE inflation forecast up to 2.7%.
And we should probably unpack what core PCE actually means because it's pretty central to the Fed's logic here. The Personal Consumption Expenditures Price Index is the Fed's preferred measure of inflation.
Right.
But the core version intentionally strips out the prices of food and energy because they are traditionally considered, too volatile.
Which feels completely absurd if you are just an everyday person. I mean, the Fed is measuring inflation by intentionally ignoring the $4 gas we're putting in our cars and the expensive groceries we're buying.
Yeah, it's frustrating.
Chairman Jerome Powell claims the Fed can just look through this supply shock. He's arguing it's a temporary blip from the war. But, I mean, if I'm paying those prices every single day, that is not a blip. That's just my shrinking bank account.
And you are definitely not alone in that frustration.
Yeah.
There is actually active dissent inside the Federal Reserve itself right now.
Really? Who?
Jeffrey Schmidt, the Kansas City Fed president,
Well,
he openly pushed back.
mm-mm.
He pointed out that inflation has been running above their 2% target for 5 solid years.
Wow. 5 years completely destroys the argument that this is just a temporary, transitory issue.
It does. And furthermore, Schmid pointed out a physical constraint on the ground. 10th District energy producers in the U.S. need oil prices to stay above $75 a barrel just to justify the immense capital cost of increasing their drilling operations.
Okay, wait, so even though oil is over $100 today?
Producers aren't going to flood the market with new supply overnight because they don't trust the prices will stay high long enough to make a profit. The supply response is simply too slow to fix the inflation problem.
Man, And the bond market is basically screaming that the Fed is making a mistake here. If we look at the yield curve, the spread between the 10-year and 2-year Treasury yields narrowed to a razor-thin 0.51%.
Yep.
Normally, if you lock your money up for 10 years, you demand a much higher interest rate than if you lock it up for 2 years because, more time equals more risk.
Exactly.
So when that gap collapses to 0.5%, what is the bond market actually telling us?
It is flashing a definitive slow growth warning. The bond market is essentially betting that the Fed is keeping short-term interest rates far too high for the underlying economy to actually handle.
Okay.
They believe the Fed's insistence on fighting this inflation with high rates
Yeah.
is just going to choke off corporate growth and consumer spending entirely.
Which perfectly explains one of the most baffling facts in our sources today, the Great Decoupling.
Oh yeah, the gold situation.
Yes. Historically, when a massive war breaks out and inflation spikes, investors panic and flock to gold, right? It's the oldest safe haven in the book.
Right.
But gold just suffered its worst month since the 2008 financial crisis. It plunged 13% before a tiny late month bounce. I genuinely struggle to understand how a war in the Middle East causes gold to crash.
Well, it seems completely counterintuitive until you look at the mechanism of real interest rates and the US dollar.
Okay, walk me through that.
So because those high oil prices forced the Fed to keep interest rates high, holding cash in US Treasuries suddenly became very lucrative. And that caused the value of the US dollar to surge to 11-month highs.
And gold doesn't yield anything. It just sits in a vault.
Exactly. When interest rates are high and the dollar's incredibly strong, the opportunity cost of holding a non-yielding lump of metal becomes too expensive for institutional investors.
Oh, wow.
So they just dump their gold to chase the high yields offered by U.S. government debt. It's a historically rare negative correlation, oil skyrocketing while gold crashes, and it is driven entirely by the mechanical reality of the Fed's interest rate policy.
So while Wall Street is playing technical games with short covering and interest rates, the physical consequences of this energy shock are just devastating other parts of the world.
Yeah, the real-world impact is severe.
To see the true victims here, we really have to travel from New York to Seoul. We are looking at a geopolitical shockwave where the epicenter is the Strait of Hormuz, but the damage completely upends South Korea's economy.
The financial data coming out of Asia is staggering right now. South Korea's KOSPI index suffered what analysts are actually calling a total valuation reset.
A reset.
Yeah, the index plunged 12% in a single day earlier this month. And by the end of March, foreign investors had dumped $23.5 billion in South Korean shares.
That's insane.
It is their steepest, most aggressive monthly sell-off since the 2008 crash.
But why South Korea? Like, out of all the Asian markets, why did they take the heaviest hit?
It comes down to two massive vulnerabilities colliding at the exact same time.
Yeah.
First, South Korea imports a staggering 70% of its crude oil directly from the Middle East.
Right.
And the vast majority of that travels right through that blocked Strait of Hormuz. Second, their entire economic engine is driven by the export of semiconductors.
And I think people forget that making a microchip isn't just, a couple of guys in a lab with soldering irons.
Oh, not at all.
Semiconductor fabrication plants, or fabs, are some of the most energy-intensive facilities on planet Earth. You are running massive clean rooms, utilizing extreme ultraviolet lithography, and cooling equipment literally 204/7.
Yeah, so if you are entirely dependent on imported oil to run a highly energy-sensitive manufacturing sector, a blockade in the Middle East is an existential threat to your profit margins.
Definitely.
But the vulnerabilities go beyond just crude oil, too. Our CBS News source highlighted that Qatar was actually forced to stop producing helium after their liquefied natural gas facilities were struck during the conflict.
Wait, helium. And helium isn't just for balloons, right? It is an absolute requirement for cooling those superheated manufacturing processes in semiconductor fabs.
Exactly.
So taking Qatar's facilities offline that wiped out 17% of the world's entire helium export capacity overnight.
It's massive.
No helium, no microchips.
And this reveals a really profound second-order insight. This war is not just a temporary disruption, it is acting as a permanent catalyst. Global capital is waking up to the fact that relying on Asia for critical manufacturing, while Asia relies on a fragile Middle East for energy, is just a recipe for disaster.
So we are looking at a massive global realignment here. Where does the capital go to rebuild those supply chains?
Well, it triggers the reshoring of capital back to the West, and it permanently enhances the value of non-OPEC oil producers. Look at Latin America.
Okay.
The smart money is pivoting toward countries like Brazil, Guyana, and Argentina, I mean, they currently represent about 10% of global oil production, but they're expected to add 800,000 barrels per day of output in 2026 alone.
Wow.
Yeah. Global buyers are actively abandoning the volatile Middle Eastern routes and trying to construct an entirely new, geographically insulated energy map.
Okay, so the global map is being aggressively redrawn, supply chains are fracturing, and inflation is biting hard. Let's look at how every day consumer-facing companies are physically adapting to survive this high-cost era.
This is where it gets really interesting.
It does, and this brings us to the biggest corporate bombshell of the quarter. McCormick, the massive spice company, is merging with Unilever's global foods business in a $44.8 billion deal.
It's a fascinating piece of financial structuring, too. The deal utilizes what's known as a reverse Morris trust to maximize tax efficiency.
Okay, wait.
McCormick is putting up $15.7 billion in cash and $29.1 billion in stock.
Let's break down that jargon for a second. A reverse Morris trust sounds like a very complicated legal maneuver. Why wouldn't Unilever just sell the division normally?
Good question. If Unilever simply sold their foods division to McCormick for cash, they would be hit with a catastrophic corporate tax bill on the gains.
Right.
A reverse Morris trust allows Unilever to spin off the food business into its own separate entity, which then merges with McCormick. It is a highly specific legal loophole designed to transfer billions in corporate value to shareholders completely tax-free.
Oh, that makes total sense. So they are creating this $20 billion global condiment giant. We are talking about putting Hellmann's mayonnaise, Knorr sauces, Frank's Red Hot, and Cholula all under one massive corporate umbrella.
The huge brands.
Yeah, and they're targeting $600 million in cost synergies. But here's the contradiction I really want to put in front of you, the listener.
Let's hear it.
We're talking about a global war, semiconductor supply chain collapses, and $100 oil. Yet McCormick is dropping $45 billion to essentially corner the market on mayonnaise and hot sauce. How does defensive scaling like this actually protect the company from the macroeconomic chaos?
It is arguably the most brilliant strategic pivot for a stagflationary environment. Brendan Foley, the CEO of McCormick, outlined the strategy perfectly. He calls it flavoring calories while others compete for them.
Flavoring calories, that is incredibly precise.
It is. Think about the consumer mechanism at play here. When inflation drives the cost of a restaurant meal totally out of reach, everyday people are forced to eat at home, but they still want the sensory experience of a premium meal. So they buy cheaper base ingredients like bulk rice, beans, or chicken, and they dress them up with premium hot sauces and spices.
But McCormick is still facing soaring raw material and energy costs to actually make those spices.
Which is exactly why they have to merge. In an environment where every input cost is rising, the only defense to maintain your profit margin is massive scale.
Right, the synergies.
Exactly. By combining operations, they can eliminate $600 million in redundant supply chain costs. Shared trucking, shared warehousing, shared purchasing power. It is survival of the biggest.
And we're seeing the penalty for getting this strategy wrong play out in real time with Nike. I mean, Nike's Q3 earnings are acting as a high-stakes barometer for the global consumer right now, and they are really struggling. They're trading near 9-year lows.
Yeah, Nike is kind of the ultimate counterexample to corporate adaptability right now. Their CEO, Elliott Hill, is frantically trying to pivot the company away from their recent direct-to-consumer, or DTC, approach.
Because that DTC strategy where Nike tried to sell mostly through their own website and stores to capture higher margins completely alienated their traditional wholesale partners like Foot Locker and Dick's Sporting Goods.
Huge mistake.
Yeah. And when times got tough, premium specialist competitors like HOKA and On swooped into those major retailers and just started eating Nike's lunch in the running segment. Now Nike is rushing back, basically begging for the broad distribution scale of those big retailers to fight back.
But, despite the struggles of individual companies like Nike, the U.S. consumer as an aggregate force is actually acting incredibly resilient.
Surprisingly so.
U.S. retail sales just jumped 6.9%. Housing demand remains elevated.
But how is that mathematically possible with $4 gas and high interest rates? Where's the money coming from?
The Kansas City Fed actually identified the structural mechanism keeping the consumer afloat. It's a severe ongoing labor shortage.
Oh, interesting.
Yeah. The U.S. currently has zero growth in its working-age population. And when demographics shrink the labor pool, it creates a firm structural floor for wages. Employers are basically forced to pay a premium just to retain the staff they already have.
And that wage floor gives consumers just enough cash liquidity to keep buying those groceries and keep the economy chugging along, basically fighting against the downward drag of the energy tax.
Exactly.
Okay, so physical commodities like oil are dictating global supply chains. Corporate America is merging just to survive the cost pressures. Traditional safe havens like gold crashed due to the mechanics of the bond market. If you're listening to this, you might be thinking, well, what about the digital world? Is cryptocurrency acting as a safe haven?
You might assume that a decentralized asset like Bitcoin would thrive when traditional geopolitical structures are burning.
Right.
But Bitcoin is trading completely flat, just hovering around $67,000.
Because it's acting exactly like a tech stock. The data shows it is highly correlated to the Nasdaq Q100 right now. When the Federal Reserve stays hawkish and keeps interest rates high, it drains the excess cash out of the financial system.
Yeah.
And that completely kills the liquidity catalyst that digital assets desperately need to rally.
Exactly. Though we should probably note that institutional accumulation, or hedgehole dealing, hasn't stopped.
Right.
Strategy Inc., the firm formerly known as MicroStrategy, purchased another 17,000 Bitcoin in March. But there is a much larger, entirely different existential threat looming over digital assets right now, one that actually makes the Middle East conflict look secondary.
The quantum threat, Q-Day. This reads like a sci-fi concept suddenly crossing over into terrifying financial reality.
It really does.
Google researchers just announced that advances in quantum computing could crack elliptic curve encryption far sooner than anyone expected.
And we really need to explain why that specific phrase, elliptic curve encryption, is the absolute doomsday scenario for crypto. This encryption is the fundamental mathematical lock and key that secures both Bitcoin and Ethereum.
Think of it like mixing paint. It is very easy to mix a drop of yellow and a drop of blue to get green.
Sure.
But if I hand you a bucket of green paint, it is virtually impossible to unmix it back into the exact original drops of yellow and blue. Classical computers can't unmix the mathematical paint that keeps your digital wallet secure.
But a quantum computer doesn't solve problems linearly like that. It can view all the probabilities at once. So a mature quantum computer could instantly derive your private key from your public address.
Which means
It would shatter the digital vault, rendering the entire ledger completely transparent and vulnerable to theft.
So if I'm holding Bitcoin thinking it is my ultimate safe haven from inflation and war, I actually have this massive technological blind spot.
Which brings us to a crucial third-order insight. This perfectly explains why crypto has severely underperformed as a safe haven compared to physical commodities during this crisis.
Right.
Yes, the geopolitical crisis drained crypto's liquidity in the short term, but Q-Day introduces a permanent, long-term technological risk to the asset's very foundation.
Wow.
Physical oil might be geographically blocked right now, but a quantum computer cannot hack a physical barrel of crude out of existence. Digital gold relies entirely on complex math that might very soon be completely obsolete.
Man. So let's synthesize all of these shifting puzzle pieces for you.
Yeah.
As we transition into Q2 2026, we are basically moving from a state of raw, unmitigated crisis into a period of what analysts call contained volatility.
Right. We are witnessing the rapid construction of a new global energy map, heavily pivoting toward Latin America to escape the Middle East. We are seeing major corporate consolidation, like the McCormick and Unilever merger, used as a physical defense mechanism to maintain profit margins. We see the Federal Reserve caught in a credibility trap, attempting to look past inflation while the bond market flashes warning signs.
And we face the sudden reality of quantum threats to decentralized money.
Exactly.
But I want to leave you with one final brand new connection to mull over, something that builds on everything we've explored today, but looks just over the horizon.
What's the thread you're pulling on?
We talked about tech companies like NVIDIA being targeted, right?
Yep.
In the tech sector, rallying on massive AI investments.
Mhm.
Yet we also saw South Korea's stock market completely collapse because the semiconductor industry, the exact industry that builds the physical chips required to run that AI, is incredibly energy intensive and is currently starving for Middle Eastern oil.
That's a great point.
So the question we have to ask ourselves is this. Are the trillion-dollar valuations of U.S. tech companies currently ignoring a massive, catastrophic blind spot in their physical, energy-dependent supply chains?
It is the ultimate disconnect of the modern economy, honestly. Wall Street is eagerly valuing the software of the future, while completely ignoring the incredibly fragile physical energy required to run it today.
The silos have truly collapsed. I mean, you cannot separate the digital AI boom from the physical oil burning in the Strait of Hormuz.
You really can't.
Well, thank you for joining us on this deep dive. Keep asking the hard questions, keep looking beneath the surface, and remember the economy is rarely as clean as a broken belt on an engine. Sometimes you just have to look at how the gears actually turn to find the truth. We'll see you next time.